For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
Investing in shares today can be your gateway to financial freedom. To participate in the stock market, you need to open a CDS and a trading account. Here's a quick guide to help you open these accounts. A CDS account. CDS or Central Depository System account is fully owned and operated by Bursa Malaysia Depository. It keeps a record of the ownership and movement of shares traded on Bursa Malaysia. Simply put, when you buy stocks, shares are credited to your CDS account, and when you sell stocks, they are debited from your CDS account. In addition to a CDS account, you also need to open a trading account with a broker. A trading account is used to place your buy or sell orders in the stock market. Let us show you how to open a CDS account and a trading account in 3 simple steps. Step 1. Access Bursa Malaysia website and choose from any of the licensed stockbrokers listed on the website to open an account. Step 2. Once you have identified your preferred stockbroker, bring along your identity card and your bank documents to the stockbroker's office for verification. Step 3. Look out for a confirmation notice from Bursa Malaysia in your mailbox in the next few days. This mail will provide you with all your account details which you will use every time you trade. If you are new to the market and would like to learn the fundamentals of stock investing, please visit www.bursamarketplace.com. That's it! With these 3 easy steps, you are ready to start investing in the stock market and move towards achieving your financial freedom. Open your CDS account and trading account today. Happy investing!
Hello everybody, welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. My name is Shen Chu. I'm the moderator for this webinar that is titled How Dividend-Paying Stocks Can Diversify Your Portfolio. So in this market, beaten down market, we could see a lot of good value or high dividend stocks suddenly emerge. So today we're going to study how can we add these dividend-paying stocks in our portfolio so we can diversify exposure. All right, so before we begin, as usual, disclaimer, whatever we share in this webinar is only for educational purpose. So in no way that I give any recommendation for you to buy or sell any companies in the event that we do any analysis on those companies. So if you decide to make any investment decision, you're 100% responsible for all your investment decisions. Is that okay? Allow me to introduce our guest speaker today, and he is Anson Tan. Now, Anson is actually the founder of Boo Bear Bursa Facebook page. So he's a certified financial planner from Financial Planning Association of Malaysia. As he's also a former research analyst and premier banking investment consultant. He has a capital market services representative license for the financial planning with expanded scope to advise on equities, debentures, or warrants listed on Bursa Malaysia. So, hello, Anson.
Hello, Shane. Hello, everyone.
Yeah, good to
Good
see you
evening.
here. It has been a while since we have you on our Bursa webinar.
Yeah, I think more than 6 months easily here.
Yeah, so we can't wait to learn from you about how we can use dividend paying stocks to diversify our portfolio. So over to you.
All right, thank you, Shane. Okay, just give me a moment for me to share my screens here, everyone.
Yes.
Okay, I guess you guys can see my screen on the learning outlines.
Yes, perfect.
Okay, thank you, Shane. Okay. So good evening, everyone. So just to test my mic and the audio, everything is okay. Can you guys just give me a 1 perhaps? Okay, if everything is okay, just give me a 1 so that I know everything is okay for you guys. So we can start the webinar today right away. Okay, great. I see many 1. Okay, so just for a brief introduction, okay, for the learning outlines today, we will be focusing on the myth of dividend investing, how to actually identify sustainable dividend paying stocks, as well as how do we actually add these stocks into your portfolio to make it more diversified and more, I would say, make it all weather, okay, throughout the good days or the bad days of the market, especially during the time like this whereby we see a lot of uncertainties, and some people actually say this is a kangaroo market. All right. Okay, so on my first slide, you can actually just a brief intro on what is actually dividend. Okay, so basically, when we actually invest into a company and we the position we have is actually we are the shareholder of the company. Okay, so when the company actually make profit, okay, so in certain way the earnings will not automatically go into our pocket as a shareholder, okay, because company is a different entity. Company actually reserves the right, okay, it depends on the management of the company. They actually have the right to actually hold and retain the earnings in the company, and for any cash flow requirement of the company, whether they still need to use the money or the cash flow for expansion or any kind of projects that needs to use up this kind of cash flow, okay. So if the company, okay, the management of the company believe and think that, hey, actually we can actually pay out perhaps 20 or 30% or even up to 50% of our earnings, okay, as a form of cash, as dividend to the shareholders, okay. So this is what we call dividend, okay. But all these things is actually depends on the company, the management of the company, the board of directors, whether they want to distribute and rewards the shareholder in this form of cash. Okay, if not, what a shareholders can get in terms of return from equity investing or stock investing is basically from the capital appreciation. Okay, the other channel of the way that you can get your returns is actually from this dividend return. All right. So the important dates that we need to know as a shareholder, basically I would just highlight to you guys in 2 ways. Okay, the first one, it will be the X date. Okay, the X date is actually the X dividend date. So basically, you just need to know these 2 dates. One is the X date, and the second one, it will be the payment date. Okay, so actually it's pretty straightforward for the payment date, whereby it's actually the actual date for the company to pay out the dividend, and it will be credited into your account on that day. Okay, so basically, if you look at, for example, this picture, okay, the payment date is actually on the 20th of May, okay, so the payment date is 20th of May, so on that day you can actually expect your dividend will be banked into your account if you are using a direct account, okay, but if you are using a nominee account, it may be on the same day or the next business day, I would say, okay, but when it's come to the X date, I realized that most of the retail investors, some of the inexperienced retail investor, they may not know what's the meaning of the X date. I would tell you, okay, because ultimately, okay, when a company want to distribute the cash from the company internally to the shareholder into the shareholder individual's pocket, right? Okay, they will need to take out the cash pile. Okay, they will need to take out the cash from the cash pile of the company. So whereby it's actually from the pocket of the company and going into the shareholder's pocket. Okay, so in that sense, when a company want to distribute a dividend, okay, when a company want to distribute a dividend, it will actually reflect on the share price of the company, whereby, for example, if the share price of the company is actually standing at 1 ringgit, and if the company want to distribute a 2 cents dividend, the 2 cents dividend will actually be deducted out from the company share price of 1 ringgit. Okay, so the 2 cents will be deducted out on the X date itself, the starting of the trading of the X date. Okay, in the morning, you can see that even though the closing share price of the closing price of the share is actually at 1 ringgit, but because of the 2 cents dividend, okay, then it will deduct out 2 cents. Okay, at the beginning of the trading session, your share price will only be remaining about 98 cents. Okay, the 2 cents actually go into your bank account, go into your pocket. Okay, so on the X date itself, right? Okay, it's the date that the dividend will be deducted out from the share price. Okay, so you can see there will be a deduction on the share price, but the money doesn't go into your account on that day. It will only be paid on the payment day. Okay, is everything clear? Okay, the key difference. Okay, so if you want to receive the payment of the dividend, you will need to make sure, okay, on 1 day before the X date, you need to actually own the share. Okay, a day before the X date. Okay, because on the X date itself, in the beginning of the trading session, they will already deduct the dividend out from the share price. Okay, so if you buy anytime on the X date itself, you can't actually get the dividend. You need to buy at least 1 day before the X date. Okay. All right. So let's go to the first agenda of our webinar today, the myth of dividend investing. So basically, I would say this is the key 5 problems or the issues or the myth that the retail investor, they don't understand about dividend investing. Okay, because most of the time when I talk to retail investors, most of the time I would say they are actually unsure about okay, how dividend investing can benefit them in their whole investing journey. Okay, most of them, they believe that dividend paying is actually very boring. The key reason that why they believe so is because when they see some certainty in dividend investing, because if you look at some of the history of the company, the company has been paying, for example, about 4% dividend yield every year. So these things are actually quite certain. Okay, when they know that when the things are quite certain, are quite guaranteed, they believe that this is very boring. When you buy the dividend stock, it's likely that the company doesn't have any growth. So that in that sense, because the company doesn't need the money for the expansion plan, so they will distribute out the dividend. So in the sense, they perceive dividend paying stock as very boring stocks. Okay, they will just say, hey, this is quite bored. Okay, because the company is not growing. So I don't like the company when the company doesn't have any capital appreciation, any room for capital appreciation. Okay. So this one is the first one. And the second one, I would say most of the time when people are actually investing into the dividend stock, they will automatically perceive that, hey, dividends are quite guaranteed and dividend stocks are always safe. Okay, dividend stocks are always safe. I would say when you have this kind of mindsets, right, most of the time, I would say you are right, okay, but this is not guaranteed. It's not 100%, okay, because, okay, most of the time, those dividend companies, when they have a very fixed or constant dividend payout policy, I would say the share price movement is not as volatile as most of the non-dividend paying stocks, okay? Because this kind of company, when they are committed to a dividend distribution policy, okay, they already can foresee, because their business model is pretty stable. When you have a stable business model, you can actually forecast how much cash flow that you are expecting to gain from your operations, and how much you can actually be utilize the cash flow to distribute as dividends to reward your loyal shareholders. Okay, this is most of the case. Okay, but dividend stocks are not always safe. Okay, why? Okay, we will actually discover and explore more later, but the key reason I will tell you is because the business itself of the company, they may still face uncertainties. Okay, for example, if you are a company that is dealing in the retail segment, okay, because of the COVID-19 situation in the past 2 years, of course, the business, the operation, the earnings will be well impacted by the sentiment, by the retail spending directly. Okay, so even though the company has been paying very constant dividend payout, but it may not means that these stocks are pretty safe all the time. Okay, the key thing is they will not be 100% safe. No, nothing is guaranteed. Okay, even though when it comes to dividend investing, nothing is guaranteed. Okay, then the next two, it will be, if the company is giving a huge special dividend, then things are actually very good. Okay, or the fifth one is actually when we look at the highest yielding stocks. Okay, if they are actually giving 20% dividend yield, then it will be the best stocks that we can have as for our dividend investing journey. Okay, the key reason that we need to understand is that dividend are actually forking out from the company's cash flow. Okay, so if the company are giving a big chunk of cash, okay, as a special dividend, okay, for example, it's about 20% of the share price. Okay, so yeah, they are giving a huge special dividend. Okay, and it will lead to, okay, and it also implied that the company, the stock itself, it will have a very high dividend yield rate for that particular year. Okay, but we actually need to drill down, okay, and understand why the company is giving such a high dividend paying rate. Okay, it may be because of the company, they actually dispose some asset. Okay, if they dispose something, they have the asset and they don't know where to utilize it for expansion purpose. Okay, so if they do not have any expansion plan in the short term, so they will just think, okay, it's better for us to actually distribute out the cash and let our shareholders to invest it somewhere else, because the company doesn't have a better or higher ROI investment for the shareholders to enjoy. So it's better for us to distribute out the dividend. If not, if you just put the cash in the banks or put it in the FD or cash management fund, the low return on that side will actually pull down the whole valuation of the company. All right, so these are the key reasons that when we are dealing with company with special dividend, we should not buy into the company because of the special dividend situation that they are actually experiencing or having. Okay, we will need to judge the company on that case. Okay, we will need to judge the company on that case. Okay, so we need to judge it on a case-by-case basis, I would say. Okay, so here I would like to emphasize on this statement, whereby high dividend pay may not means that the company or the counter is a good company. Okay, in this investment world, there's many possibilities. We will still need to judge the company on a case-by-case basis. All right. So, okay, this is an example that we can have. Okay, I actually did a slide, I guess, in 1 year plus ago. So if you go and search on all these companies, the dividend yield is actually not the latest, I would say. Okay, so these are some of the top 10 high dividend yield stocks in Malaysia. Okay, back in, I think, early of 2021. All right. So you can see, like this company, Cigars, they are actually paying close to 130% dividend yield, all right? Okay, so speaking on the example that I mentioned just now, on the high dividend high dividend yield stock doesn't mean that it will be all the time as this case. The key reason is if we look into the financial statements of the companies, and if you look into the quarter reports, we can actually see that the company actually disposed one of the wholly owned subsidiaries. Wholly owned, it means that they own 100%, all right? The wholly owned subsidiaries, and they actually posted outstanding return because of the disposal. So because in that case, okay, because of the disposal, so they will actually pay out a special dividend for the shareholders. Okay, so they will just pay out a special dividend for shareholders. Okay, so in this sense, we will need to understand that the company already, okay, so the entire share capital of subsidiaries. So in the sense, and we can see that from the case of the Cigars, we actually know that the company, after the disposal of this company, the wholly owned subsidiaries, they doesn't have any operation anymore from the company. So they will be classified as a PN 16 company because there's no material business activity. So in this sense, we shouldn't invest into the company because of the high dividend yield. Okay, this is some of the case that we need to be aware, because most of the time when I has been dealing with retail investors, I realize that they don't really drill into the rationale, okay, drill into the case why the company is giving such a good dividend, this good dividend payout ratio, okay, the good dividend payout policy, okay. But in that sense, they only look at the dividend yield, then they perceive that, hey, this company is having a good business model and they are giving a high dividend yield, so we should actually invest into it. So that may not be the case, okay? So this is actually the first case. So on the second part, we will actually look into some of the characteristics, okay? Some of the characteristics of the good dividend stocks should have, and how we should actually look into it and actually explore whether it's actually suitable for us to hold them as a dividend stock in making our whole portfolio more stable and more diversified portfolio. Because the key reason we should actually put dividend stocks into the portfolio is because they will come with a lower volatility. And most of the case when the market is volatile, this kind of low beta characteristic can actually make our portfolio performance more resilient. So in that sense, if the risk profile of the investors, okay, are actually more conservative, the dividend stocks is something that they must consider and put it into their portfolio. All right. Okay, so the first thing, it would be on the stable industry. Okay, the first thing, it would be on the stable industry. So if the company are actually operating in a stable industry, most of the case, they will come with such a characteristic. Okay, the first thing is that their products or their services demand, right, is actually very long-term and stable. For example, if you are actually dealing with in the retailing segments, for example, if you are selling F&B related products, for example, like Nestle, okay, once you already forms your good branding in the industry or in the market, the consumer already has been consuming your product for a long time, and it means that your product and your services, actually you created a very long-term demand for your products. Okay, so in that sense, you seldom see any volatility in terms of your business revenue case. All right, so this is the first thing, and it also means that the business model itself is non-cyclical, okay? Because no matter the market is in a good market or in a bad market, okay, the non-cyclical features or characteristic means that your earnings are unlikely to be volatile, because no matter what happened, okay, the consumers or the client base will actually, they will still need to consume and they need your service. no matter how. This is the main key reason how come your earnings stream will be so stable, okay? And the next one it will make your company highly defensive in terms of the share price, because the investor, they know that your income stream is pretty stable, okay? And it's non-cyclical. So when it comes to valuation, people are they will actually tend to hold on to your shares easily. They will actually prefer to hold on to your shares, even though when the market is not performing well or in the stage of many uncertainties, just like what is happening right now. All right. So the highly defensive feature in the stocks itself also make your valuation more stable. It also turns into a more stable share price. Yeah. Okay. So a stable industry, okay, will actually means that your valuation will be something that is close to moderate or cheap or moderate, I would say, okay. The key reason is because when things are pretty stable for you, those investors that actually buy into your company, they will expect that things are pretty stable. You will actually give a constant or growing, okay, a growing dividend payout rate, okay. So whereby most of the things are actually within their expectations, okay. Most of the things are within their expectation because the whole outlook or the business model itself is pretty stable. Stable means that there's very little uncertainty that may impact, okay, that may impact your income stream in that sense, okay. So when it comes to valuation, you will need to make sure when you are picking a good dividend stocks, right, okay, you will need to make sure in terms of the valuation, things are at least moderate or cheap, okay. These are at least moderate or cheap. You shouldn't chase after those dividend paying stocks that is having a high valuation, okay, because you will need to know for dividend paying stocks, they are likely to have a stable business model. So in the sense, if they are having just a stable business model, the valuation shouldn't be expensive, because you can't actually expect a very good or fantastic growth from the company in the upcoming future, unless that company, they are actually still having a very good growth, okay, at the first place. If the company are still having a very good growth and they are also paying dividend, normally in the real life, we seldom see this sort of companies, because in the realistic world, if they have expansion plan and they are still experiencing some growth, okay, if they are still experiencing some growth, they will actually use the cash flow to fund for the growth and the expansion. So they normally won't pay out that kind of dividend, I would say, in the realistic world. All right. So in terms of the more valuation, make sure that things are actually at least moderate or cheap. All right. So, okay. So if we are looking at the earnings wise, just like what I say, the earnings of the company are likely to be stable, okay, because they have a stable earnings, okay, in terms of revenue stream or net profit. Things are pretty stable. That's why they can actually promise, or they actually commit to a constant dividend payout, or a fixed dividend payout policy to its shareholders, to reward the shareholders in this case. All right. The next one, it would be a stable dividend payout. And from some of these examples, we can actually see that from Maybank, Tenaga, Sunreach, and actually Hub Sing, they're actually having a very stable dividend payout rate. Okay, it's just that for Sunreach, it may be a bit different, okay, because due to the COVID-19 situation in the past 2 years and things are not looking so well, so they actually reduced their dividend payout. Okay, so this also link back to the first characteristic that I actually said. Okay, dividend investing, dividend stocks are not all the time always safe, because their business model or their business operation may still be impacted by some of the unexpected situation or circumstances that as an investor we couldn't expect, I would say. All right. Okay, so on the next characteristic, it will be a stable share price. Okay, why I would actually put the stable share price in this this scenario, the key thing is I would like to emphasize to the all the investors here, or be it you are a beginner or experienced investors. Okay, when it comes to the dividend investings, one of the key characteristics of the dividend yielding stock is that they will normally having a stable share price one. Okay, the key reason that makes their share price so consistent or resilient, okay, is because of their dividend paying policy. Okay, those who actually opt for dividend investing, they will normally, okay, they will normally hold it, they will normally hold the stocks, okay, be it any kind of market cycle, okay, because they know that when it comes to when during the market is bad, when the market is bad, the other growth company, they will of course experiencing some slump in their share price, but when it comes to dividend paying stocks, things will be more stable because the dividend payout rate has been committed and they are delivering this kind of dividend payouts. Okay, so in terms of the share price, the drawdown or the volatility will be definitely lower, I would say. All right. So you can see from some of the example here, the Naga National or Hub Things. All right. The next characteristics, it will be the high dividend, it will be the high cash holdings of the companies. Normally, when a company they're actually committed to a fixed or consistent dividend payout policy, they will need to have a lot of cash for the this kind of dividend payout. So normally they will actually have a very big cash pile for all this distribution purpose. Okay, so normally if you look at the cash of the company towards the on cash per share basis, right, it will be at a very high percentage. All right. So when it comes to the dividend stocks investing strategies, we will need to actually ask ourselves, okay, as an investor, we need to ask ourselves whether we will need to ask ourselves all these questions. Okay, so if from this checklist, all these questions and the checklist, you can actually have a tick over all these things, right? Then it will be a good dividend stocks that you can actually consider or putting the stocks into your portfolio. Okay, this is how me, myself, or the normal investors, okay, the dividend stocks investor are actually looking at the company, I would say, to consider and to make sure there are some good dividend paying stocks. Okay, so the first thing, okay, so summarizing what we actually what I actually explain and what we actually go through just now. Okay, is the industry of the company the company is in is considered stable? Okay, whether the industry is a stable industry, if the company is actually in a sunset industry, okay, for example, like the cigarette industry or some of the sunset industry that you can think of, I would say, okay, some of the sunset industry, then even the company is paying a fixed or very consistent dividend payout, you also shouldn't consider this kind of company. Why? The key reason is because if the company is in the sunset industry, although they are having a very high market share in the company, ultimately over the long run, the earnings of the company will definitely shrink. Okay, the earnings of the company will definitely shrink. So they will earn less and less money over the years. So it doesn't make sense as an investor for you to put your money inside this kind of company if you are choosing them because solely because of their high dividend paying you. Okay, it doesn't make sense. So the first thing you need to make sure the industry that the company is inside, okay, make sure that things are at least very stable or is slowly growing. Okay, so the first thing, industry. The second one whereby you need to be aware is whether the company has, okay, whether the company have a competitive edge or advantage in this business or business model. Okay, so if the company can be replaced easily or in the industry, okay, or they do not have any edge towards some of the competitors in the industry, then I would say you will need to be careful with the company. Okay, you will need to be careful with the company, because it can be, I would say, they can actually, for some of the example, this kind of company, they can make some good profit for a run of a few years, but they couldn't deliver this kind of stable earnings perhaps more than 10 years. So in the sense, if you're putting your money into this kind of companies, right, and the uncertainty over the stable earnings will definitely be there. Okay, so it may suddenly that when the company are not so competitive and they are not having a good earnings stability over the next few years, then it will trigger a sell-off in the company share price, and the share price will start falling already. So in the sense, even if you earn so much in the dividend paying, but you will still lose out most of your capital in the pricing of the share price. Okay, this is the second question that you need to ask yourself. Does the company have competitive advantage in their business? All right, then the third one, it would be, is the company growing steadily with positive profit area? Okay, this one is a pretty common sense one now. Okay, pretty common sense on whether the company is making profit every year. Okay, if it's not making profit every year and things are pretty more volatile, sometimes they are making good profit, but sometimes they are actually making some losses, then of course you shouldn't consider this company to put in to your portfolio as a dividend stocks, because you need to understand, okay, a dividend stocks serve as a defensive player, okay, a defender lah. I would say a defender in your portfolio. It will help your portfolio to defend, okay. But if this player couldn't have some consistent positive profit output, then it may not be the case for you to consider to input the company into your put this company into your portfolio already. All right, then the next one, it would be the fourth one, it would be the financial health of the company. Is the gearing ratio of the company acceptable? Because ultimately we need to understand that when it comes to gearing, right, okay, we need to understand every industry, they will have different standards of gearing expectation, okay. I would say gearing expectation, because normally I see some problems among retail investors, is that when they look at some of the companies, they will say, hey, this company is very bad because they are having debt to equity ratio easily more than 100%. But they didn't go and find out why this company are actually having such a high gearing. So for example, if the company are having if the company are having those kind of projects, okay, projects or concession projects, whereby they can actually expect an inflow of cash flow for the next 20 or 30 years. For example, if they are managing or owning a toll, okay, so they can actually foresee the upcoming cash flow of this asset itself can actually generate them perhaps, for example, 30 million every year. So in that sense, they actually use this I would say the high certainty cash flow to actually finance for the debt, okay, to finance it using debt to finance for the projects, okay. So in that sense, this kind of gearing ratio is actually acceptable for this kind of infrastructure in nature business, okay. So we will need to access into the business model itself at the first place. Okay, so we shouldn't look at the gearing ratio directly to judge that the financial health of the company is good or not. Okay, we shouldn't judge it the health in this sense to see whether the gearing ratio is high. Okay, so I shouldn't look into this company. Okay, but you should need you need to actually judge the case differently for all the companies. Okay, some of the companies, they may have a very high ratios of cash inside the company, but if the business model is not sustainable and things like that, so it doesn't mean anything for a company to have a good financial health. Okay, it doesn't mean anything, even though the financial health of the company is very good, but they still couldn't give you the certainty in terms of their business operation generating cash flow ability, like I would say in that sense. Okay, so we will need to see the and judge their financial health on a case-by-case basis. All right. Then the next one, it would be, does the company have a free cash flow or sufficient cash for the operation? Okay, this one is very straightforward one. So you need to make sure the company have enough operating cash flow. If the company doesn't have enough operating cash flow and the whole business itself are not having a positive free cash flow throughout the years, then it will be in doubt that the company will still have the cash flow to pay out for dividend distribution in the future. Okay, these are something that we can actually see from some of the balance sheet or the P&L signals already. Some of the signals we can get if the company for the 2 or 3 years they are not having positive free cash flow from the business, then we may need to start to doubt whether 5 years or 10 years down the road, do the company still have the money to pay for the dividend or not? Okay, this is something that we need to be aware of, you see. Then the next question is, does the company pay dividends steadily every year? Okay, because we need to know not all company that is listed in this world, be it in the Bursa or the rest of the world, okay, that will have a very clear and transparent dividend paying policy. Not all company. Some of the company, they will position themselves as a dividend paying company, so they will straight away tell in the annual reports or tell it publicly to the investor, communicate this in a clear message to tell that we will at least, okay, pay up 20 or 50% of our net profit as dividend to reward shareholders every year. Okay, so when we are considering to put this company into our portfolio, this is a very key question we need to ask ourselves. Is there any transparency in the dividend policy that the management has already communicated to the investor? If there is no, right, okay, you couldn't just look at the short track record of a few years to judge that this company will definitely pay dividend throughout the next 10 to 20 years, okay? Because it may be just because some cyclical cycle of the company they are making good profit throughout the past 3 years, so that's why they are giving good dividends. But if the company the business model is not stable and things are not looking so well for the next few years, they will immediately stop the dividend paying. They will stop paying dividend in that sense. Okay, so we need to make sure that whether these earnings or this dividend paying ability is one-off or they have the ability to do it over the long run. This is a very key question that investors need to think about it. All right. Then the last question is, we need, it still comes back to valuation. I would say when we are doing with stocks investment, everything is related to valuation. You will need to judge, okay? You will need to judge whether the stock's valuation is reasonable. Okay, in this sense, right, valuation, we can actually access the company valuation from a few angles. Okay, sometimes, although the company have some good earnings generating ability, okay, but it may only happen for these few years. Okay, so in that sense, if their current PE are low at this moment, but we need to look beyond the current time. We need to look beyond and look at the future, whether how long or can they actually sustain it in this way? Can they actually sustain this dividend paying amount over the years? Okay, if they can, then it will actually justify the valuation that in paying at this price, then it makes sense, it's reasonable. But if they couldn't sustain the dividend paying ability throughout the years, then if in the forward PE or the forward EPS that you are looking at the company, you know, in the next 5 years, I guess they will start to earn lesser, be it maybe 20 or 30% down from this current level. So you will know the valuation at this sense is slightly expensive already. So in the sense, you will still need to go back to the valuation. If you manage to buy the company stocks at a very fair or reasonable valuation, then it makes sense for you to buy into that company. But if the valuation is expensive, I will tell you, even if you get a very good dividend yield for a short term, be it 10%, 15 or 20%, okay, it also will reflect back on the share price one, because the share price will drop. In that sense, you will earn it and you will gain it from the dividend itself, but you will lose out from the share price movement of the company prospect that leads to the falling share price. All right. So this is the checklist that you guys can actually look at it. So perhaps you guys can have a screenshot or write it down. Yeah, some of the checklists that you should have, all right? Okay. So how to actually find a dividend stocks? So if you actually go to the Bursa Malaysia, the Bursa Marketplace, okay, you can go to the segment tool. Okay, the tools set aside, you can actually find the screener. You can actually find the screener, and by filtering out some of the requirements that you need, whether the 5 years dividend growth, the dividend payout percentage, you can actually see how many stocks there is actually matching. Okay, what's the result, or how many counters or companies that's actually matching the requirement that you need, the dividend requirement that you need. Okay, so in that sense, you can actually look at the company list and start filtering out some of the requirements or checklists that I have provided to you guys in this sense. Ask yourself all these questions. Then you can start to cancel out some of the company that is not hitting all some of these requirements. All right. Then the remaining company that is left over, those are the companies that you can actually start to have a better FA analysis into the company, understand more on the business model, because in terms of business model, it's not so easy. You will need to spend some time to understand about their business model, their positioning in the industry and things like that. All right. So yeah, this is the way how to find a good dividend stocks and pull it into your portfolio. That's all for my presentation today.
Thank you so much, Anson. If you have any question to ask Anson, you may write in the Q&A box, yeah? So, Anson, we have a few very, observant attendees today who spotted an error on your slide. Could you go to slide 6? I want to thank them for discovering that. Yeah, there were some mistake at the X date.
Hold on.
Yeah. Investors who buy on X date by right should not be entitled to dividend.
X date is on the 30th. If you invest, oh yeah. All right. Yeah. This example, there are something wrong with it.
Yeah, it should be before 30th. And then the last
29.
sentence.
Yeah, you need to buy it at least. The latest is on 29.
Yeah.
If you buy it on the 30th of April, you will not receive it. Yeah.
Yeah. Apologies. Clarification.
Apologies for the mistake here. Thanks for the
Yeah. If you sell on the X date, the seller will still be entitled to the dividends. But if a buyer buy on the X date, then cannot get dividend.
Yeah.
You have to buy at least 1 day before the X date. Okay, so a little error here. So apology. All right, so if any question to ask Anson, you may write in the Q&A box, not the chat box, okay, so we can easily manage your question. Geoffrey would like to ask, if a stock consistently pay out dividend, but its share price did not bounce back to the previous peak, but show declining trend, what should we do?
Okay, so you guys can hear me, right?
Yes.
Nothing wrong with. Okay, so I would say most of the time when you have this kind of company whereby once the company pay out the dividend and the share price will not move upward, it will start to go down every day. In that sense, there must be something wrong with the company business model. Operationally, they are not making consistent return already, or the valuation is high. Okay, so you will need to go back to some of the questions in the checklist that I shared previously in the, perhaps I can stop at that slide. Okay, because some of the example that we can see, I would say, for example, 2 years back, we see it, I would say this year, we see it from the glove example that we say high dividend yield one-off because of the extraordinary situation from the COVID-19. Okay, the extraordinary earnings that the glove counters are having, they give out a very good dividend, paying case for one-off, just like the plantation counters that we are looking at in the market right now. Okay, some of them, they are actually paying more than 10% dividend yield already. All right, so if things are, it's just one-off and we know that they couldn't sustain at this kind of level, this is the, I would say, a FA trap, or value trap that dividend investing investors should avoid this part. Yeah.
Okay. I think one of the more prominent dividend stocks is like the Naga, so the share price keep declining for several years, right? So the next question is, for good dividend paying stocks such as Maybank and the Naga, right? Do we need to put a stop limit, like cut loss point, to write over in case of any volatility?
Okay. Normally when it comes to dividend paying stocks, right? Normally when it comes to dividend paying stocks, they will have you will need to assess the situation in two scenarios. Okay, the first thing is you need to because actually it links to the business model, this part one. Okay, links to the business model, this part one. If the company are a very stable company or a very big company whereby they hardly enjoy any natural or unnatural growth in their business operation in terms of revenue. So which means if you ask yourself a pretty straightforward question, how much the company can actually grow from this level, from this current year, in the next 10 years, if the answer that you give yourself perhaps is just a 2-3% organic natural population growth, so in that sense, things may be not so within the expectation. Okay, things may not be so within the expectation if some of the unexpected factors come out to impact the company in the earnings end. For example, like Tenaga case, how come the company has been paying good dividends payout, but the share price has been dropping, I would say dropping slowly throughout the past 2 years. Okay, the key reason is because when inflation hit the markets and the cost, okay, the cost of them to generate the electricity has been going up. So in that sense, it's actually squeezing the margin of the Tenaga over this period. Okay, so as a dividend investor, the key question we need to ask ourselves, as I mentioned just now, the business model. Like the second question, does the company have the competitive advantage in their business? Okay, so for the example of Tenaga, they actually don't enjoy a good competitive advantage in the business. Why? Although they are actually doing a monopoly business in Malaysia, but we need to understand one thing. Okay, the capping and the electricity tariff, the rate is actually fixed by the government of Malaysia. So if the government don't agree to actually subsidize or actually allow them to revise the price, these kind of short-term factors will actually impact the company on the margin end. So this is some of the things that we need to pay attention into the details. Okay, so normally when it comes to dividend investing, it's not so straightforward when you look at some of the things like cash flow and all these things, then you can straight away make the decision. That's why I mentioned that you will need to spend some time to look into the business model or the industry outlook itself. Because the key reason we want to buy into dividend stock, the key reason is because we want peace of mind. We want peace of mind. We don't want to worry about the business model over any situation, or even that the market is concerning about the war situation, but I can still sleep peacefully because I know that my company are still generating stable income. This is the thing.
If you like stability, prioritize dividend stocks in your portfolio. Okay, now just now answer, you talk about gearing ratio, right? So Kok Chin would like to ask you, how do you define gearing ratio?
Okay, in terms of the formula, okay, the common formula that we will use to classified as a gearing ratio is actually debt over the total equity of the company. Okay, so in that sense, it's actually in layman term, I would say, like how many dollars of your company's funding are actually funded by the channel of debt financing. For example, if the company have $100 in the company, okay, the company have $100 in the company, and $40 is actually funded by the shareholders. So this one is equity part, $40, and $60 is actually funded by the gearing part. So in that sense, the gearing ratio is 60 over 40. Okay, so it's 150% in this case. Okay, so I would say, as I mentioned just now, we couldn't just look at the nominal value, be it above 80% is high, below 80% is low. We couldn't just judge the number by the number itself, okay, because it will link, and it still highly depends on the business nature, the nature of the business operation of the company. Okay, some of the industry infrastructure, they will have very high gearing ratio, but it's okay because it's actually funded and guaranteed by some of the cash inflow that they will get from their concession project in the future. Okay, it will need to depends on the business itself also lah. And if some of the company, like some of the developers where they have a lot of lands, so in this kind of developers, right? Okay, so if their debt are actually backed by some of these good land banks of the company, then things may not look that bad also. So we need to judge the case on a case-by-case basis. Yeah.
Okay, thank you so much, Anson. Now, Andy would like to ask, at current uncertainty and geopolitical environment risk premium, how much dividend yield you think is reasonable for investor?
Okay, looking at the looking at the dividend premium, risk premium that we are looking at, right? Actually, it depends on yourself also, okay? Because some of the conservative investors, they may believe that if 4% is actually good, but some of the investors, they may actually demand more, okay? Some of it, they will actually demand more. But I would say, looking at the state, I would say like even throughout the past 20 or 30 years, Malaysia, interest rate environment has been pretty stable compared to some of the developed countries in the world. And I would say at this moment, 4 to 5% dividend yield is actually quite sufficient.
Okay, you think 4 to 5%, huh?
Mm.
Is adequate for that. Okay. Now, Marcus would like to ask, notice that some companies, when it comes to dividend, right? Some dividend require shareholders' approval, while some do not need. Why is this so?
Okay. Actually, for the normal dividend, for the normal dividend, it doesn't require the shareholder needs, but for final dividend, it will require.
You mean interim dividends do not require shareholders' approval, whereby final dividend at the financial year end require shareholders' approval?
Yep.
There are also some companies that can pay more than 100% dividend payout ratio. How is this sustainable?
Of course, this is not sustainable. So that's why in the example just now, I actually pick up the Seagas that is paying close to 130% dividend yield to the shareholders, because they actually dispose a company some asset so that they actually get the cash and they just distribute everything to the shareholders in the sense. Okay, so normally I would say when we are looking at dividend yield, there is more than 8 to 10% and above, right? I would say most of the time the dividend paying is only one-off. It's definitely not sustainable one. Yep. It may be due to some of the cyclical factor in this year or these 2 years, the company are made earnings outstanding, extraordinary earnings. There is at least a few fold for their normal level. So they are giving special dividend, and that's why the dividend yield is so high. But that's why in the sense you need to access and look into the reason why the company is giving such a high dividend yield for that particular years. It's impossible for the company to constantly paying more than 20% dividend yield.
Okay. Now, David would like to ask, during the bear market, nearly all stocks are affected. would you consider selling your dividend stocks that you bought a few years back when you have been able to enjoy good dividend yields all these years?
Okay, to answer this question from David, right, I would say normally we won't do so because as experienced investors, we will emphasize more on managing our portfolio as a whole. So it's more towards asset allocation already. So give me a few minutes, perhaps I can actually explain more in this sense. So for example, if a portfolio for you that's actually making up 100% of your asset, okay. So for example, if you are foresee, okay, in the normal circumstances, normal situation, you actually put 50%, 50 of your 50% of your investment into a dividend stocks, 50% into growth stocks. Okay, this is how you allocate your money towards your holdings. Okay, so for example, if you are expecting the market to experience a bear market, there will be a lot of uncertainty moving forward. So in that sense, what would you do? Reduce your exposure in the growth stocks, because you know when this uncertainty hits the market, when all these headwinds hits the market, things will actually these growth stocks, they will actually experience even worse performance, share price performance compared to all these dividend stocks. So normally what I personally do, I will actually reduce, okay, I will actually reduce my exposure in the growth stocks and increase my exposure in the dividend stocks, or even read some of them into cash, because I would like to emphasize to investors, as an investor in the market, it's quite impossible for you to actually time the market correctly all the time. That's impossible. Even portfolio managers or fund managers, they don't try to time the market in that sense, because it's impossible for you to time the market correctly all the time. So what you can do is actually, according to your view towards the market situation, and you believe if the market is going to perform quite badly throughout the years, so what do is you reduce your high risk exposure in the exposure in the growth stocks, and you not growth stocks, the growth stocks, and you put some of your money into the conservative defensive end of your holdings, like dividend stocks, to make sure things are more resilient even when the market is bad. And when the market really come down as what we expected, then that time your holdings in the dividend, you can actually liquidate them and convert them back into the cheaper growth stock that you can buy later. This is how we actually do. We adjust our formation rather than we say, oh, we don't want to play and we just cancel the football match. Yeah.
Okay, understand. The next question is,
perhaps I elaborate more like
sure,
in the real life example. Okay, like what we see from the market recently, whereby we see a sell-off in the technology space. Okay, whereby we see a sell-off in the tech stocks in Malaysia or globally. Okay, one of the key reason is because as the market are expecting rate hike from the US end, and we are actually looking at a more hawkish stance in the central banks in the world. Okay, so in this sense, okay, theoretically we will say, because of the high valuation of the technology stocks, okay, because of the high valuation, it triggers a sell-off. Okay, it triggers a sell-off. But I will tell you, from the other end of the portfolio asset allocation angle, it actually also means that the fund manager, they actually trim their exposure in the growth holdings. They trim their exposure in the growth in the technology space, those stocks that can give them a very good growth at this point of time, and they trim it and they put into something that is more conservative. That's why you can see the drawdown in the technology space compared to some of the recovery or blue chips or some traditional sectors. Things are looking more stable over the other end. This is what the fund manager has been doing. They has been rebalancing their portfolio, reduce and trim their exposure in the high risk, high growth and want to pull it into something that is more conservative. Okay, this is how the rebalancing that's working, the asset allocation that I mentioned just now.
Okay, thanks so much for the clarification. How do you see dividend with reinvestment plan? So this is a question by Ya Yun.
Okay, so normally when the company actually come out with the reinvestment plan, it means that they will tend to offer you an option whether you want to convert this cash dividend into some new shares for the for the company. Okay, so normally I would say if the company are having a very good growth, looking at that few percentage points, okay, that few percentage points of the new issuance of shares, for if the shareholder actually opt for the reinvestment plan, it doesn't impact the company over the long run one. But we would need to assess the growth of the company to see whether the growth of the company are actually constantly higher than the reinvestment plan, whereby because the reinvestment plan, it will trigger some new issuance of shares. Okay, so for example, if the company is giving 6% dividend yield every year, and up to 50% of this dividend you can actually opt for reinvestment plan. So it means that if 100% of these shareholders opt for the reinvestment plan, which means the share pool, the outstanding shares of the company will grow at least 3% every year. So we need, as investors, we need to ask our question: this 3% dilution, can the growth, the organic or the growth of the company can actually overcome this 3% dilution every year or not? If the answer is maybe they can just overcome slightly higher, or the natural growth of the company is barely 2-3% in the sense. So if that's the case, I would say you can actually see, okay, if the company growth is only 3% and the dilution every year from the reinvestment plan is also 3%, right? I would say you can barely see any chance of capital appreciation in the company share price already. So we need to judge it from this angle also, whether the dilution, the impact on the dilution can be overcome by the growth of the company or not.
Okay.
If the answer is yes, then you definitely can consider.
Okay. So Sue would like to ask, what methods can we use to evaluate dividend stock so that we can pick a moderate valuation?
Sorry, can you repeat the question again?
What methods can we use to evaluate dividend stock so we can pick it at a moderate valuation?
Oh, valuation and okay. So for the first thing, you need to go through the checklist first, okay? Because all these things also leads to whether the company is having a reasonable valuation or moderate valuation, okay? But when we are talking about valuation, I would say the most common trap that the dividend investor go into, okay, and buying the high valuation dividend stock is when the company are paying one-off dividend or special dividend, or they are having cyclical, they are actually having some cyclical end, and they are gaining a very good earnings for this particular 2 years, and that's why it translates into a very good dividend payout from these 2 years, and dividend yield are very high, and investors are actually trapped in the sense, and they believe that even the share price drop is okay because the dividend yield is so good that I can actually get it for every year. So this is the most common trap that investors always go into. Okay, so the first thing I would say, I will advise you guys to check and see whether how sustainable is that dividend policy of the company they can actually maintain at. Okay, so the constant one, if they only can maintain it at a reasonable 5-6%, then you need to look at the valuation. Okay, so if the PE is within the reasonable average, then it's okay already.
Okay, thank you so much, Anson. What is the optimum number of stocks in our portfolio? What do you think about this? This question is by Theo.
Okay. Actually, for this question, there's no one menu for all, no one formula or one menu for all scenario, I would say. It depends on your risk profile, I would say. Okay, if you are very conservative investors, the more the merrier, of course. Okay, because if we look at some of the funds, okay, unit trust funds, whereby when a fund manager, they need to try to minimize the non-market risk in the end, okay, they will need to actually at least hold 50 to 100 stocks in their portfolio. Okay, that's the normal case, because they will eliminate all the specific company risk, and just because the market risk you can't actually avoid or evade from the escape from the market risk. Okay, if you want to stay invested in the market, so what you can do is just eliminate those specific company risk in the end. Okay, so going back to the question, sorry, what's the question again, Ashim?
Optimum number of stocks in the portfolio.
Optimal number of stocks. It depends on your risk profile. Okay, because if you are very aggressive investors, and you pay a lot of attention and you spend a lot of time to look into the companies, I would say sometimes less than 10 or so is okay one. But most of the time, when you are aggressive and you request a very high return in your portfolio, then dividend stock may not be something that is you should be looking at really most of the time. Yeah.
All right. So now you briefly talk about valuation, right? So Stephanie would like to ask, what PE ratio is acceptable to so what is the PE ratio acceptable to the health of a company? So that is the question.
Oh, I would say this one is two different thing for Stephanie. Okay, because if we are looking at the price to earning ratio of the company, which most of the time it means the valuation, whether it's high or low valuation for the company, it depends. The valuation is more towards like what's the value that you are buying for that company. Okay, but if you want to look at the financial health of the company, it's more towards the balance sheet, and whether we need to think about whether the cash flow of the company is sustainable for the company to run its operation or not. So it will be a two different thing. One is more towards on the P&L, and one is more towards on the balance sheet end. Okay, so I would say for dividend paying company, they can be a two different scenarios. Okay, some of the company, they may have not so good profit generating ability. Perhaps they are actually paying out close to 80 or 90 or even 100% of their earnings, but they have a lot of cash, then they have a lot of land banks or a lot of asset in their book. So in the sense, this asset also can generate a few percentage points of investment returns for the company to distribute out the dividends. So if this is the case, even if the company are loss making also, they actually have this kind of financial health to distribute dividends. Actually, some of the company dividend paying, good dividend paying companies in Malaysia also, you can see some of them, they can pay you very consistent dividend payout, and this kind of company sometimes they are also making losses over the years, but because on their balance sheet they have a lot of asset and they can use the asset to fund for the dividend paying in that sense. So it depends also. Yeah.
Okay. Now, and so just now Theo clarified that for the portfolio question, he referred to retail investors.
For the portfolio, what's the question again?
The optimum size of the portfolio. That I think he clarified that he said he referred to retail investors.
So yeah, so for normal retail investors, I would say normally within 10 stocks are a good number of stocks.
Okay.
Yeah.
The next question is there a screener for written dividend policy of all stocks in Bursa Malaysia?
No.
It's by Andy Chi.
Yeah, there's no, because for written dividend policy, it will be something more qualitative. When it comes to qualitative things, you need to do your own research already, because it's pretty hard for them to actually capture all these things from the wordings from news or annual reports. Yeah.
So the screener can only help us to filter the current dividend yield.
Dividend yield or some of the nominal amount of the dividend that they are paying. Yeah.
All right. Rosalie would like to ask, some companies indicate their dividend policy while some do not. Is this a good thing for those that indicate their dividend policy?
Yeah, of course, it's a good thing, because for dividend investors, you need some of this commitment from the management, so you can actually take their words as your investment objective. Yeah.
Okay. Albert would like to ask, REIT, 100% all REITs of Malaysia, right, pay out more than 90% of their income to the units holders because they want to enjoy the tax-free status, right? So the question here is this kind of market good for REITs?
Okay, so the first thing that I will need to define this kind of markets, I assume that you're actually assuming that the market condition right now, I would say, if we are looking at this kind of market condition, you can actually see, you must be quite curious. Hey, how come the REITs company share price has been the REITs company has been performing so badly recently? The share price has been going down every day. Okay, actually, the market normally perceive REITs company like something that is they actually enjoy the characteristic of fixed income, just like a bond. Okay, because they are committed and they are some sort of required, okay, to distribute most of their incomes for the tax exemption purpose. Okay, so in the sense, they actually have the feature or the characteristic of a bond, a fixed income instrument. Okay, so they are giving you something that is pretty expected in terms of dividend payout. Okay, it's pretty expected. So in that sense, right, okay, in that sense, those kind of market will actually perceive them as something, as an investment. They are giving some sort of fixed income related companies. Okay, so this is the reason why when the central banks in Malaysia or globally, they are having a hawkish stance on that sense that they want to increase the interest rate. Okay, this kind of REITs company will actually, their share price will start to come down. The key reason is pretty simple. Okay, because if you buy into the company at the share price today, and you lock into the dividend yield of 4%, when the interest rate environment has been so hawkish, and throughout the next 2 years, perhaps our OPR will already go back to 3% point. Okay, so in that sense, FD can actually give you a 4% depository rate. So in that sense, it will reduce the attractiveness of the REITs company at this kind of dividend yield valuation. Okay, so in the sense, the share price of the REITs will have to come down to give a higher dividend yielding rate to attract those investors to come in again. This is the reason why the REITs company share price has been performing so badly recently.
I see. And Anson, would you want to show us how to navigate the screener on Bursa Marketplace to find dividend yield stocks? Because there are many people who ask for what are the recommended dividend stocks in Malaysia, but unfortunately we can't give any investment advice here. So maybe you'll run through screener to demo a bit how to find dividend stocks.
Okay, you give me a moment. I will just
apology. So
yeah,
in this
no
webinar, we
problem.
cannot give any investment advice.
Okay, hold on. Okay, you can see from my screen, right?
Yes, perfect.
On the browser.
Yes, perfect.
Okay, this is where you should go and find your screener. All right. So bursamarketplace.com screener. So like the example I showed just now, actually you can go and put a reasonable one. more than 25%. Okay, for 5 years is quite reasonable. And dividend yield, I would say the rest of the thing you can just put it all, or perhaps PE you can put something that is cheap below 10. Dividend payout, a reasonable one, 33 to 50%. Okay, then there's only 4 matches, so we can go and see the results. Yeah, so these are some of the companies that's hitting all these kind of requirements. So what we need to do next is we need to drill down into the business model of the company. Okay, not all the companies here I know in depth what they are doing, okay, but I can see like Hatta Lega, they are still having a good dividend yield of 20%. But at this point of time, I believe most of the investors know that the earnings are they cannot sustain the earnings that they have been enjoying for the past 2 years. So the upcoming earnings will definitely shrink and be lower from this level, from the previous level. So on that sense, the dividend yield will definitely come down again. Okay, so from what is the homework that we need to actually do from this sense is we need to look into the business model and the industry outlook of Hatta Lega. From the end, the next step we need to actually look into it and predict. Okay, look at all the factors that is affecting the business and the industry of the company, whether what kind of earnings level we are foreseeing, we are expecting from the company. Okay, of course, all this kind of homework you can also look into some of the research report from the analyst recommendation, and look at some of the guidance that the management has been giving to the analysts, and where is the reasonable level that we can expect. And then you can actually translate all the views into a more reasonable PE or dividend yield in the sense, because at this moment we can see that the PE is very low, the dividend yield is very high. Okay, because we know that in the past 2 years the earnings has been very great, so it makes the PE so low whereby investors already start to factor in the forward PE. There is at least about 15 to 20 PE from this level, which is 3, where it's extremely low, I would say. Yeah, so they will still have okay, I would say your homework or your work actually start here. When you get some of the matches from here, then only you can actually start to look into all these company individually. Okay, rather than you say, hey, once I get this result, then I can straight away buy into all these stocks. No, your homework actually starts here.
Okay, so a screener will help us to quickly filter down the dividend stocks that meet our criteria. Okay, you can set, what is the dividend yield that you like, what is the dividend growth rate you like, and what is the dividend payout ratio that you like, and and the PE if you like. So you can use the screener. This is the free screener provided by Bursa Marketplace for all investors to make use of, to help us to make our homework faster and efficient. All right. So Kok Jin would like to ask this question, which I think you pretty much covered that before already, but for the sake of time, maybe you briefly answer that. Now, what is your view on company which pay dividend per share higher than their earnings per share?
Okay, I would say most of the time, this kind of situation are unsustainable. So we need to find out what's the reason they are paying the dividend per share higher than their earnings per share. And you shouldn't be misled by this ratio itself. Yeah, you shouldn't be misled by the higher dividend per share to then you go and buy into it. Like, you shouldn't be misled by that. Yeah.
Okay, yeah, many of them pay out from their retained earnings, if they are dividend
or one-off earnings. Yeah.
All right. So okay, I think we have another question here is, what is the perspective of IGB REIT?
My perspective from IGB REIT. Okay, I would say in terms of the business model itself, IGB REITs are having a very matured business operation whereby in terms of the location wise and some of the tenancy selection available in the REITs market, right? Okay, if you look at the REITs market as a whole, they are having a very matured selection for some of the tenants in the market. So I would say the competitive advantage that the IGB REITs have towards some of the competitors that's doing the same business operation, operate as a shopping mall operators, okay, they are actually having a very good edge towards them, okay. So I would say the problem with IGB REITs at this moment, if you look at the share price has been performing quite badly recently, is mainly because of the reason that I mentioned just now, because of the interest rate environment, and funds will need to rebalance their portfolio from all these fixed income related characteristic income company into something that is they will need to look into the company again later, but not now. That's why they need to rebalance out their holdings in the REITs.
Okay, so Anson, looks like you have answered all questions that appear on my panel, whether in chat group or in the Q&A box. So it looks like we have no more question left. Maslan asks, is the next webinar in English? The next webinar will be in Mandarin. All right, so that will be the first Mandarin webinar by Bursa in this year. So in the meantime, allow me to share my screen. So thank you, Anson, for doing this webinar for us.